Welcome, my name is Geoff Driver, General Manager of Business Development and Investor Relations for Australian Foundation Investment Company. I have with me today Mark Freeman, the Managing Director and Chief Executive Officer of Australian Foundation Investment Company, and David Grace, a Portfolio Manager responsible for AFIC, as we call it. So Mark, we've just released our half-year results for the 31st December 2021, and we had quite a significant increase in income from the previous year. And we also maintained our dividend. Do you want to run through the sort of highlights of the maintenance of the dividend and what was our thinking behind that, and also what drove the increase in income for the year, or the half year, I should say?
Yeah, sure. Well, I guess the main thing is we had a good recovery in the dividends we received from the major banks. We've also got a good holding in Macquarie Bank, and so they paid out a nice dividend. And there was also a recovery in dividend payments from companies such as James Hardie and Ramsay.
Yeah, and I guess also the maintenance of the dividend, we had a large increase in income, but what was the thinking about maintaining the dividend rather than sort of any increase at this point in time?
Yeah, sure. Well, as we sort of pointed out a number of times over history, when we get significant pullbacks in the market, we had one obviously during the GFC, and then a couple of years ago when COVID first hit. Many companies we invest in pull back dividends, or in some cases cut their dividends. And those periods we draw on our reserves to maintain the dividends. We understand that our investors like a more consistent dividend profile. So in essence, we've been topping up our dividend over the last couple of years to support that maintenance. Earnings are now recovering, our income is recovering. So at this point, we've been able to sustain that dividend. And then as we look forward, if earnings continue to rise, then we hopefully we can start to get dividends to rise to our shareholders as well.
Thanks, Mark. So David, the portfolio outperformed quite well over the 6 and 12-month period to the 31st December 2021. You want to sort of run through what are the major sort of factors driving that outperformance?
Sure, thanks, Geoff. So the portfolio performance for the 6 months was up 6.9% versus the index up 4.6%. And for the 12 months, the portfolio was up 22.4% versus 18.7% for the ASX 200. So pleasingly, we're able to deliver this performance with reduced volatility in the market, and that's a good sign. Our investment process is very heavily focused on quality companies, so by nature, they should be less volatile than what the market is. In terms of stocks that we own that performed particularly well, we had strong performances from the likes of Macquarie Group, Mainfreight, James Hardie, Goodman Group, and the performance was also aided by the takeover offer received by Sydney Airport. In terms of stocks that we don't own, not owning Afterpay and Fortescue also contribute positively to our performance, with both companies having particularly tough last 6 months.
Thanks, David. Perhaps you could run through the adjustments that were made through the portfolio over the last 6 months.
It's been a pretty active period in the portfolio over the last 6 months. We added 2 stocks to the portfolio, being JB Hi-Fi and WiseTech, and both companies, we view them as having a very strong market position and in a position of market leadership. Given the sell-off or weakness in share prices in a number of our existing holdings, we took advantage of the opportunity to add to those companies at what we deem to be really attractive long-term prices. So we added the most material amount in stocks like Transurban, CSL, Coles Group, Goodman Group, Domino's Pizza and BHP. And on the selling side, we exited 6 companies throughout the period. 5 of those, we just felt the competitive intensity set to become more pronounced, and really over our 5 to 10 year time horizon, we felt that the opportunities to become more challenged for the likes of APA, Lifestyle Communities, Cube, Origin and Altium. And the last one that we exited was the takeover offer we received for Milton Corporation, which is an LIC that we owned, which was bid for by Soul Pattinson's during the period.
So we had some recent volatility in the market since the end of the calendar year. Would either of you like to comment on what's driven this and what the outlook potentially is for the next 6 to 12 months?
Yeah, look. Obviously, the key event that's occurring in markets is the discussion around interest rate rises from central banks globally. Everyone's expecting the US to start that process, and that's caused markets to reassess their assessment of value And we've been keen to point out that a number of our high quality companies did have very good runs in the last 6 months up to December. That did help our performance. Certainly some of those have come back a bit in January. But really that's the catalyst. But the interest rate or the potential interest rate increases, that's really a factor that is dislocating what were some very high valuations. So, and we sort of hear about the quality stocks had run very hard and growth stocks, and there's been quite a significant adjustment during January. But that sort of process or rotation seems to be settling down a little bit, although markets are still weak. We still think we're holding very good companies for the long term, and I'll let Dave perhaps touch on that point.
Yes, I think despite those challenges on the macro front, we still feel that we're invested in high quality companies, and most importantly, the companies we're invested in to have really strong balance sheets, so they're able to self-fund growth options from here. They're not likely to tap equity markets for additional capital. And some of our larger holdings are still able to deliver meaningful earnings growth despite the challenge on the macro front. So Transurban, for example, we still expect to see more cars on the road next year than last as we move further away from the onset of the pandemic. For CSL, we expect to see still strong demand for their life-saving therapies, and equally for ResMed, where we see more patients requiring treatment for sleep apnea. So overall, we feel the portfolio is well positioned, and if markets prove to be volatile, as Mark mentioned, we'll use opportunities like these just to add to our existing holdings at prices we deem to be attractive.
Okay, thank you, Mark, and thank you, David, for your time, and hopefully viewers have found this interesting video for them and have given an aspect about how we go about investing and what the highlights of the result were for 31st December 2021. So thank you.